A big plate of economic data and news this week. We do our best to break it down into bite-sized pieces in this week's Fastest 4 Minutes in Finance. Hello again, I'm Scott Inman. Well, the stock market has rallied in July with major indexes up as much as 6%. And all this has happened amidst the release of some disappointing economic data, much of which was released this week. One of the two biggest headlines: the Federal Reserve raised its short-term interest rate by 0.75%. Now, this was not really all that disappointing. The move was on target for what most all economists had predicted. The Fed is continuing to try to slow inflation by making it more difficult to borrow money. So it's only bad news if you're looking to borrow money. The other big headline, though, was the release of preliminary second quarter GDP. That stands for Gross Domestic Product. In essence, this is everything the U.S. produces. And it showed economic growth is slowing. GDP was down 0.9% compared to the second quarter of 2021. This follows a 1.6% decline in the first quarter of this year. A traditional definition of a recession is 2 consecutive quarters of negative GDP growth. But there are other factors considered. Officially, the National Bureau of Economic Research declares recessions, and that hasn't happened yet. In other news, 175 companies reported earnings this week, and many reported a slump in those numbers, including big names like Microsoft, Google, and Facebook. So what gives here? Why have we seen stocks go up while the economic news has been negative? Well, it's mainly because all of the news was expected. The market pulled back earlier this year because investors expected what's happening now. And there seems to be light at the end of the tunnel. There is a growing consensus that inflation may be peaking, and we will see slower price increases in the fall. That could help consumer spending, which in turn adds to corporate revenue and growth. So some of those companies that reported sluggish earnings also pointed towards a rosier picture in 2023. The unemployment rate is at a 50-year low. Bonds are performing better. Fixed income returns have been behaving more like equities for the first half of 2022, but the major bond indexes have been positive in the past month as yields normalize amid this rising interest rate environment. We do believe there will be more volatility in the near term as investors continue to read the tea leaves for what to expect out of the next 6 to 8 months. But it's always a good reminder that the equities in your portfolio should be long-term investments. If you need to sell in the next 6 to 8 months, you really shouldn't be buying. The purpose of the stock investments in your portfolio should be for long-term growth to meet a long-term goal. That way, negative returns over the next 6 months, or really even next 6 years, shouldn't disrupt your plan. And whether we are in a recession or not only matters to your personal economy. Are you still able to earn income to be able to meet current expenses with enough margin to contribute to your investment accounts to meet your future financial goals? Thanks for listening.